Noah bought a rental house, and Mason bought gold. Both of them believed they had made the smartest possible move to protect their money. Noah believed real estate would slowly build wealth through passive income, while Mason believed gold was the safest asset in an uncertain economy. One wanted long-term cash flow, and the other wanted security. Both felt confident in their decisions. But 20 years later, one of them had built an income-producing asset worth hundreds of thousands of dollars, while the other was left holding an investment that had never produced a single dollar in income. And when you compare the actual numbers side by side, the result is not what most people expect. Let's make this fair. Noah and Mason are both 30 years old. They each have $60,000 saved, and they both earn $58,000 a year. Same city, same salary, same starting point. The only difference is how they decide to invest that money. On the surface, both choices seem smart. One offers stability, the other offers leverage. One feels safe, while the other promises growth. But over time, those differences create outcomes that are far apart. Noah uses his $60,000 as the down payment on a $280,000 rental property in a growing suburban neighborhood. It's not a luxury home, just a standard three-bedroom house in a decent area where rental demand is strong. He locks in a 30-year mortgage at 6.8%, and after taxes and insurance, his monthly payment comes to around $1,650. He rents the property for $2,150 per month. On paper, that gives Noah around $500 in monthly cash flow. It looks like an easy win. The tenant is covering the mortgage, the property is appreciating, and Noah believes the house will eventually pay for itself. From the outside, it looks like the perfect passive income investment. It seems like all he has to do is collect rent and wait while the property grows in value. This is the dream most people imagine when they think about owning rental real estate. Mason takes the same $60,000 and buys gold. Part of it goes into physical gold, and part into a gold ETF. No mortgage, no debt, no tenants, no repairs, and no leverage. Just one asset that people have trusted for generations. In Mason's mind, gold is simple, stable, and safe. It doesn't need maintenance, it doesn't depend on renters, and it feels secure in uncertain times. During the first year, Mason feels like a genius. Gold prices surge nearly 20% as inflation fears rise, and his $60,000 quickly becomes $72,000. He didn't fix anything, didn't take on debt, and didn't have to deal with anyone. His money simply grew. It feels effortless. From his perspective, he made the smarter move while Noah took on all the stress. Meanwhile, Noah's easy passive income doesn't feel passive at all. Just 3 months after buying the property, the water heater fails and costs him $1,400. Then a plumbing issue shows up, costing even more. A few months later, the tenant unexpectedly moves out, leaving the property vacant for over a month. No rent is coming in, but the mortgage still has to be paid. Taxes still have to be paid. Insurance still has to be paid. The bills continue, even when the property earns nothing. Before Noah can rent the house again, he has to repaint the interior, clean the carpets, and pay listing fees. That means even more money out of pocket. By the end of the first year, Noah realizes that the $500 in monthly cash flow he calculated on paper wasn't real profit at all. After repairs, vacancy, maintenance, and turnover costs, he actually lost money in the first year. The passive income that looked so easy turned out to be expensive. Meanwhile, Mason hasn't had to answer a single phone call. No repairs, no vacancies, no stress. His gold sits quietly in his account, and from the outside, he looks like the clear winner. That's exactly what makes gold so attractive. It feels effortless. It looks like wealth growth without the headaches. But there's one major problem with gold. It produces nothing. No rent, no dividends, no monthly income, and no cash flow. Gold only makes money when the price rises. That means if prices stop rising, the investment earns absolutely nothing while inflation slowly eats away at its value. It may protect value in certain moments, but it does not generate value on its own. That's exactly what happens over the next several years. After the initial rally, gold prices flatten out. Some years they rise slightly, and some years they fall. But overall, growth slows down. Mason's investment isn't compounding. It isn't producing income. It's simply sitting there, waiting for the market price to move. Time passes, but the asset itself isn't working for him. Noah's rental property, however, starts changing. His mortgage payment stays fixed, but rents begin rising. By year 5, the rent increases to $2,350 per month. By year 8, it reaches $2,550. But Noah's mortgage is still around $1,650. That gap between income and expenses starts getting bigger. For the first time, Noah begins generating real positive cash flow. The property that lost money in the early years is now paying him every month. At the same time, the property itself is appreciating in value. What felt painful at first begins turning into real wealth. If the home grows at just 3.5% annually, that $280,000 property becomes worth nearly $395,000 after 10 years. At the same time, every mortgage payment reduces the loan balance. That means Noah's equity is growing from two directions. The home is increasing in value, while the debt is decreasing. This is where leverage begins to work in his favor. Mason's gold has increased too. At an average annual return of around 7%, his $60,000 grows to roughly $118,000 after 10 years. That sounds like solid growth, and it is. But Noah's total equity position is already much higher. By year 10, Noah has property appreciation, mortgage paydown, and years of rental income behind him. His wealth is growing in multiple ways at once. Mason only has one source of growth: price appreciation. And over long periods of time, that difference becomes massive. Now, fast forward to year 20. Noah's rental property is worth around $560,000, and his mortgage balance has dropped dramatically. He has built hundreds of thousands of dollars in equity. Along the way, rental income has continued increasing as well. Even after maintenance, repairs, taxes, vacancies, and unexpected costs, Noah's total net wealth from the property is somewhere around $450,000 to $500,000. Mason's gold investment, growing at around 7% annually, is worth roughly $232,000 after 20 years. That's not bad growth, but it's less than half of Noah's total position. And the reason for that gap comes down to one thing: leverage. Noah used $60,000 to control a $280,000 asset. Mason used $60,000 to buy $60,000 worth of gold. As Noah's property appreciated, he earned returns on the full value of the property, not just on the cash he invested. That leverage multiplied his gains over time. But Noah paid for that leverage with stress, repairs, vacancies, maintenance, risk, and years of active management. Mason had simplicity: no tenants, no repairs, no debt, and no stress. But that simplicity came at the cost of slower growth. And that's the real lesson here. Gold protects wealth, while real estate builds wealth. They serve completely different purposes. One gives you stability, and the other gives you growth through leverage. The biggest mistake investors make is treating those two things like they are interchangeable, because they're not. The safest investment is not always the one that creates the most wealth, and the highest return investment is not always the safest. The best investment is the one that matches your actual goal. If your goal is security, gold makes sense. If your goal is long-term wealth building, real estate can create much larger upside, but only if you understand what comes with it. Because every return comes with a trade-off. Higher returns demand more effort, more patience, and more risk. Lower effort often means slower growth. That's the price of convenience. And once you understand that, investing becomes much clearer. Because in the long run, the best investment is not the one that feels safest. It's the one that gets you where you actually want to go. If this breakdown gave you a new perspective, hit that like button so more people stop guessing and start looking at the real math. Subscribe for more no-fluff money comparisons like this, and comment below. If you had $60,000 right now, would you buy real estate or gold?